Have you ever looked at a stock price and wondered why it keeps changing every second? Is it controlled by big investors behind closed doors? Or is there something else going on? If you've ever felt confused by the stock market, you're not alone. In this video, we'll break it down in the simplest way possible. By the end, you'll understand how stock prices move and why they go up or down. Welcome to Martek Finance, where we simplify investing. Quick disclaimer, this video is for educational purposes only and not financial advice. How stock prices move. At its core, the stock market is just a marketplace. There are buyers and there are sellers. Every second, people are trying to buy stocks at the lowest price, while others are trying to sell at the highest price. Now here's something most beginners don't know: the order book. Think of it as a live list showing what buyers are willing to pay, bids, and what sellers are asking for, asks. On one side, buyers are saying, "I'll pay this much." On the other side, sellers are saying, "I won't sell for less than this." The stock price you see? It's simply the last price where a buyer and seller agreed. The price battle. Stock prices move because of a constant battle. If buyers become more aggressive and start offering higher prices, the stock price goes up. If sellers get desperate and start lowering their prices, the stock price drops. Imagine an auction. People keep bidding higher and the price rises. Now imagine a clearance sale. Everyone wants to sell quickly, so prices keep dropping. That's exactly how the stock market works, every second. Important insight. The price you see on your app is just the last trade. It doesn't always mean you can buy or sell at that exact price right now. The real price depends on live bids and asks in the market. Why stock prices move? Now let's talk about the bigger question: why? Why is one stock $5 and another $500? This comes down to something called intrinsic value. Intrinsic value is the real worth of a company based on its fundamentals, things like earnings, assets, and future growth. Think of it as the company's true value without hype or fear. If a stock's price is lower than its intrinsic value, it may be undervalued. If it's higher, it may be overvalued. But here's the catch: intrinsic value isn't exact. Different investors can calculate different values for the same company. There are several common methods investors use. Discounted cash flow, DCF. Estimate future profits and calculate what they're worth today. Dividend model. Value a company based on the income it pays to shareholders. Asset-based value. Take total assets and subtract liabilities. PE ratio. Compare the company's earnings with similar companies. Each method gives a different perspective, and none of them are perfect. Famous investors like Warren Buffett rely heavily on intrinsic value. They look for undervalued companies and hold them for the long term. Their focus isn't on daily price changes, it's on long-term value. Why prices don't always make sense. Here's the reality: stock prices aren't always logical. Sometimes they're driven by emotions. Market sentiment plays a big role. When people feel confident, prices go up. When fear takes over, prices fall. Interest rates, inflation, and news can also move the market quickly. And sometimes it's just speculation. So let's quickly recap. Stock prices move because of buyers and sellers constantly negotiating in real time. Understanding this gives you a strong foundation as a beginner. The stock market isn't random, it just seems confusing at first. Learn the basics, stay consistent, and always do your own research. If you found this helpful, don't forget to like, subscribe, and share. I'll see you in the next video.